All right. Well, hello, everyone. My name is Caitlin Moore. I am your 401k educator with Union Bank and Trust. We hold the retirement plan for Crete Carrier, so that's why I'm here. We're going to be doing a 3-part podcast specifically about investments, retirement related. We've broken them down, and today we're going to be talking about just FAQs. So these are the questions that I'm getting a lot from Crete employees that are calling in. As the educator, I'm the one that takes the phone calls, and so we're just going to go over some basic questions, retirement related, specifically investment related when it comes to your account. And today I have with me Joe Recker. He is our investment officer at UBT. He's been with UBT for about 9 years, and his title is investment officer, but he has a certificate or certification designation as a chartered retirement planning counselor from the College of Financial Planning. So it does make him legitimate to answer these questions. So thanks for being with us today, Joe.
Thanks for having me.
All right, so let's start off. Like I said, these are frequently asked questions that I'm getting as the educator from Crete employees calling into me about their retirement plan. So we're going to be talking just questions. So I'm going to kind of spout them out. If I can answer, I'm going to, but I would love your input if I'm missing anything along the way. So the first one I have that I get the most is, what is the difference between a 401k and an IRA? So I hear the language a lot when folks call in. They'll say, I want to talk about my 401k and my Roth IRA. And I have to correct and say, well, this isn't an IRA. You have a 401k, kind of picture you as the umbrella account owner of a 401k with a company. And under that umbrella, you have 2 buckets of money, which is pre-tax and Roth dollars. Roth IRA being a separate account. Anyone can open that at the bank. It's not attached to a company, right?
Correct.
Am I missing anything there?
Nope.
Okay.
And kind of just the source of where the money comes from is different. Yeah. You know, the 401k is going to be deferrals from your paycheck. Mm-hmm. IRA is going to come out of your bank account. Perfect. So those are kind of the main differences. And, you know, for a lot of people, if you're fine with, especially with the Crete plan, it's got great investments. If you're fine with that, you know, a lot of people, you're good. Just max out your 401k before you go outside into an IRA, because like you said, you have that Roth bucket that you can utilize. You can do pre-tax. You can do either one of those.
Yep. Yes, that's exactly it. So we could do pre-tax dollars, we could do Roth dollars, a mixture of both. So when we're talking today and for future episodes, we are not talking about IRAs. So we're going to make that very clear. We're not talking about IRAs. If we mention Roth, mention pre-tax, we are talking about within the 401k, because 401ks indicate that it's a company plan, which Crete has.
Yep. Those would just be different, either buckets or sources, however you want to define them. Yep.
All right. Awesome. All right. So the other question that I get a lot, it's usually the opener of the phone call. Hey, I'm calling to see if I'm in the right investment.
Yep.
Okay. My response is always, well, that's relative to who you are, your emotions, how risky you are, things like that. But when somebody asks, am I in the right investment? When it comes to investing, what would your response be?
There's a lot that goes into that. A lot of it's, you know, the main thing for a lot of people is their age. You know, how old are you?
Why would
how much
that matter?
have you saved? You know, because as you get closer to retirement, you might want to shift some of your dollars to funds that are maybe less conservative. They may
more
not take
conservative.
As much as you get older, as you get closer to retirement, more conservative. And younger folks that have more time to weather those ups and downs in the markets, they can afford to take more risk typically, if you know. But some people's risk tolerance just is different than others. Where if the markets, there's a lot of volatility in the markets going up and down, you might lose sleep at night. So that, you know, there's another thing you have to factor in.
Yeah. And when we say volatility, we're not talking about major downswing. Volatility means the ups and downs. You could have major ups, major downs. You could have just some minor ups and downs, which is, you know, expected in the daily market. So when we talk volatility, I think that resonates as a very negative word. But it's not. It's not always a negative word. So when we're thinking about my risk tolerance, how much can I take? We're really saying, hey, can you take the ups and downs? Yep. Can you handle that emotionally without getting stressed about it? Because when things are up, we love it. When things are down, we don't. Yep. But that's a huge factor. So the younger you are, the more of that time you have to kind of weather those ups and downs, that volatility, whether good or bad. But the closer you get to retirement, you want to get a little bit more conservative because you don't have that much time to.
Yeah, especially if you're getting ready to, if you know you're going to have to start withdrawing out of your account, because then, once you start taking money out of your account, obviously those dollars that you've taken out of the market, they can't recover in a market downturn. So you really need to make sure you're allocated correctly, depending on your age, situation, risk tolerance, all those sorts of things.
But really, there is no correct answer to this. I think that's what we really want to stress, is that there's no right or wrong answer. You can have a 21-year-old that doesn't want to take a lot of risk. You could have a 60-year-old that plans on retiring in 5 years that says, I'm all into the market. There's no right or wrong. So when somebody's asking, am I in the right place? There's a lot more questions that we're going to ask. Really, your age, what's your plan? Are you going to dip into this right away with retirement? There's a lot of things that go into that, but then the choice is yours. There's no advisement on this to say, hey, you should be in this, you should be in that.
If anything, just make sure you're well diversified. Is one thing that you can do if you're not sure in a good way. We'll talk about these a little bit more, but the target date funds are a good way to create that diversification, in your account. So keep those in mind.
That'll be episode 3.
Yep, so that'll be episode 3. So just, we won't get into that too much, but just wanted to throw that out there.
Well, actually, this whole thing brings up the next question about market timing. So market timing being this idea of when should I move things around to make the most money or protect my losses? And it has a huge factor in when deciding what is best for you. What do you want when you're investing? Can you go into what is market timing and how does that affect our retirement funds?
Yeah, so some people, if the markets are going up or going down, like let's say the market's going down, some people, their inclination is going to be, I got to get out of the market. I'm going to try to time this. I'm going to get out before it hits the bottom, and then I'm going to get back in, at the best time,
when it's starting to go back up.
Yep. When it starts going back up, and I'm going to make a lot of money that way. But the reality is, for a lot of people, you don't know when the bottom of the market is. You don't know when the market's going to recover. You don't know when any of this is going to happen. So a lot of people end up getting out at the wrong time. And so timing the market is a lot more important than timing the market. So, writing it out is usually the best course of action for most people.
Yeah. And market timing, when it comes, like the urge to sell when it's going down or buy back in when it's going up. With retirement funds, I mean, I like to tell people, we're not trying to make money tomorrow. We're trying to make money in 20, 30 years. And working with mutual funds, which we'll get into that in a later time, but with that, we're not buying and selling on a daily basis. We're not day trading our accounts. So then market timing is really a risky thing to attempt to do when it comes to a fund design that's really supposed to be long-term.
Yep. 401ks, and then inside of that, the mutual funds are all designed for long-term investing.
And when we say long-term, we mean years.
We're talking 10 plus years,
right?
At least.
Yeah. Perfect. Yeah. Awesome. So what would you say? I want to hear what you would say before I chime in, but what would you say to someone who asks, I'm catching up on lost times. What's the best fund for me to make more faster?
I mean, if you're just talking funds, you probably want to be a little bit more aggressive, more equity based than bond based. But, in those situations, if you do need to catch up, your best course is going to be just save more.
Save more money. Put more money in there if you can. Be a little bit more aggressive with your allocations. And when we say equity, we mean more stock exposure, mutual
stocks,
funds. Exactly.
The plan has bond funds, stock funds. It's got just a stable value fund. It has different offerings.
Yeah.
And we're talking about the equity funds would be considered more aggressive.
Sure. Yeah. I hear that so much. And one of the biggest things I encourage people to do is just put more in if you can. Take advantage of the full match. Profit sharing with Crete is a great perk of the plan itself. But if you could save more, you have more to invest, more compound interest in, the time period that you have to be in the market. Exactly. So, yeah, good. So how do we know if we're getting good or bad advice? So I'm sitting here with you, the investment guy. You're allowed to give advice, but you usually don't as far as these retirement plans because, we can't tell you what's the right or wrong thing because that's not a real thing. If we all knew how to make $1 million, we would, right?
We don't have enough information to advise people in a 5-minute conversation on the phone or whatever. So, people seeking advice. So when I hear this a lot on the phone, people are getting a lot of information from everywhere.
podcasts, friends. I like to make the joke even just in my job, like everyone has the brother's best friend who knows how to do investing. We all know somebody that's probably pretty good at it. But there's a lot of information that can come in. And I'm a true believer that you can Google whatever you're looking for. If you think one way about something, you're going to find plenty of information to back that up. So how do we know if we're getting good advice, bad advice when it comes to investments?
It's hard because everybody has an opinion, on everything. But, one thing we talked about this yesterday, don't listen to broke people, talk to successful people that that have done well. They typically, know how to make money and have done successful in doing so. So that's a good way to do it.
I love that. Don't talk to broke people. Don't get advice from broke people, right? Who are giving you advice on your investments when they're not doing well. That's a really good starting point right there.
And people that aren't experts, some people that maybe give an opinion on, we've talked about like Bitcoin and things like that. They might not be experts in that. So always seek somebody that has a lot of experience and expertise. And
there's definitely people that this isn't their career path and they're really good at it. So we're not negating the folks that really know what they're doing. Just be cautious of who you're talking to when they're not specializing in this field, and seek out. I think we talked too about
ask questions. Ask questions.
And both sides of the opinion, because maybe you're looking for one thing about what is this? What's best for me at my age? Or is a mutual fund better than an individual stock? Things like that. But look at both sides because they may bring up a point you didn't think about that may really apply to your situation and your risk tolerance even over time. So, so just encourage everyone to look at a wide array of opinions or information when it comes to getting advice, but seek the people who know who are doing it and doing it well, and that are experts in this area, which I, as an educator, am not the person to give advice. So if you do call me, which feel free to call me, I will give you all the information you could want on these investments within your 401k here at Crete. I just can't tell you what to do. That's the thing. I'm not an advisor. It's above my pay grade, unfortunately. Actually, probably fortunately, because I don't want to give bad advice and be held against me. So, but I'll go through all the ins and outs of the funds. If you need more information that I don't have, I usually refer over to Joe for more information. But we just can't tell you what to do in the end.
So and give education, but no advice.
Yeah. Well, I think this sums up my my biggest questions that I get when I get callers in. And these really come from Crete employees, but there are a lot of these carry over to a lot of different companies that I work with and different sectors of the market. So it's not just specifically Crete, but these are definitely ones that I hear the most. And I appreciate you responding to these. Hopefully it kind of sets a foundation for the other episodes that we're going to have. But stay tuned because we're going to be talking about target date funds and really fun basics. So let's get into the nitty gritty of what these funds are and how they work. So thanks for listening.